And running, and we are good. We are now live. Okay, so welcome to Finance Fridays. I am Jocelyn, and I am here to spread financial literacy and common finance tips in order for you to be successful and utilize them to the best of your advantage. And I'm very excited today because this is our first official Finance Friday. And if you are unable to continue through this live, then it'll be available on YouTube, which the link will be in my bio for that. And every single video will be up, so that way you can access it at any point at any time. Today's topic is, let me pull up my notes. Where are my notes? Okay, boom. Today's topic is bank accounts. And I know bank accounts is probably something that you do have. If you're working out of a Cash App or anything, what type of bank account that's considered to be. And today's topic is just the generalization of bank accounts, how you can actually utilize them to your advantage, and how you can make your bank pay you. So, the little bit of backstory and a little bit of history about bank accounts. Like I said, we are on YouTube live and we are on TikTok. So if you have any questions, feel free to drop them in the comment section and I will get to them once I see them. If I haven't already covered it within the topics of today. All right. Without further ado, let's go ahead and get into it. So, bank accounts. Bank accounts are issued by banks, credit unions, savings loan institutions as a secure way to store your money and to make it accessible later. So, basically, you don't have to carry all of your money with you everywhere you go. You don't have to carry large sums of money and wads of money in your pocket. And you usually have about two options if you're starting with about $500, and that's typically your traditional savings account and traditional checking account. So before we actually get into how to make money through your bank, we first need to understand how the bank makes money off of you, because the bank is essentially a business and we want to understand how they make money off of you first, so that way you understand what you're getting yourself into and how you can utilize it to your advantage, right? So historically, banks made their money by issuing loans, and the loans they loan out people, money, and then they charge them an interest rate, and the interest on those loans are the hold on, I am I need some water. Okay, the interest on those loans are how the bank makes their money. Okay. So, however, if a bank is going to make loans, then they need money to actually loan out. Like they need something to be able to give that is an asset. And this is where the first bank accounts actually came from, attracting people to give their money to the bank so that way they can loan it out and earn a profit. And of course, people didn't want to just hand out their money and give it to the banks. So banks advertise some different perks and incentives on why you should give your money to the bank. And so some of the ways that they got people to give money into the bank was basically saying that it was more secure. Like if you keep all your money at home, that somebody could come in and steal it. And banks are much harder to rob than your home or your apartment. And they also incentivize that you pay for it. So banks also pay you an interest on the money that you store with them, paid out in an interest that they charge other people from borrowing that same money through a loan. And that is how the banking system actually began. So in this case, both you and the bank get a good deal, and they get paid interest when they issue out loans, and they give you some of that interest as a thanks for letting them use your money, as a thanks for letting them borrow your money. And this really goes into how wealth management is actually built and created and what it's established on, right? So in recent years, banks do a lot more business than just issue out loans, and there's an entire world of products that the banks actually offer, helping people invest their money, creating and selling mutual funds, and much more. But this is often more profitable than just issuing out the loans, and it does not require people to store their money at the bank in order for them to sell it. So both sides usually get a good deal here too. People who want to invest but who are not actually comfortable investing their own, they have an expert to help. So that's the service that the banks offer. And then the bank can actually pull the assets of money of many savers to make bigger investments and earn bigger returns. So that's a way that they kind of like flip the money. And now that we have some type of idea of how the banks earn their money, we can see how they make you money. Because essentially, if you structure it the correct way, your bank account can pay you money, but you have to know which type of account to have and how to actually utilize it and all of that. But we'll get into that. So first, let's go over the different types of bank accounts. I need some water. 1 second. Hold on. Whew. Alrighty. I should have had that prepared first. I didn't know my mouth was about to be this dry. Okay. Yes. All right. So, any questions so far about how the banks make their money? They make it off of the interest payments, off of loans that they give out to people, or basically holding your money, and the interest payments that those people pay, you get a percentage of that. All right. So, the two most common bank accounts are your checkings account and your savings account. And typically, if you have about $500, you can open up any one of these, and those are your like basically starter accounts, right? There are also other types of accounts like certificates of deposit, which are commonly known as CDs, and the money marketing accounts. And we'll cover that a little bit later. But first, let's talk about checking accounts. So, checking accounts are the type of bank account that you would use for regular purchases. Originally, that was just writing checks, but it ended up turning into a checking account, which are tied to your debit card and can be used to pay like bills online. And this means that most people don't typically keep that much money in their checking account just because these are expenses that happen on a daily basis, right? So you're always depleting from that account, you're always pulling from that account. And so banks don't really use this money to issue loans to other people because at the end of the day, that money needs to be accessible and it needs to be liquid. We'll talk about what that means a little bit later. But what was I saying? Okay, so yeah, most people don't keep that much money in their checking account just because that is like kind of like their daily expenses where they pay out bills, where you should be paying out bills from. Um, so yeah, most banks don't use that money to actually give out loans. But that does not mean that banks don't offer checking accounts just out of the goodness of their heart. They still need to make some type of money. Instead, they use the checking account to make money through you by charging you user fees and upselling. So when they charge you a user fee, basically that's a fee where you say, sometimes they will phrase it as an annual fee that you pay for your checking account. Usually it's less than about $100, and the annual fee may be waived if you keep a minimum balance. So that way they can use this money to actually issue loans. That's when like that little $15, $25 fee is waived. They also make money through your checking account by upselling you. So if you have a checking account at a bank and they see that you're starting to grow your account balances, the bank will usually try to convince you to open up a savings account or use some of their wealth management services. And if you need a mortgage or another loan, if you place the first place that you typically look at would probably where you're already banking at because you've already had a relationship with them and they're more likely to give you that loan. But that is how they make money off of your checking account, by upselling you into another service on top of charging your user fees. But those user fees again can be waived if you keep a minimum balance within that bank account. Any questions on that? All right. Upselling really has become more and more of like a business model for the banks because at the end of the day, the banks are still a business. And many banks offer a free checking account, or even if you pay a small amount of interest on your checking account, just so that way you'll be able to be in the front line when you need a loan or any type of their additional services. They kind of say you already have like rapport with them, and so that is their incentive to get you to bank with them. That's when you get letters in the mail saying like, hey, you get a $250 bonus if you come and open an account with us, and yada yada yada. You have to read those terms and agreements, because 9 times out of 10 people only see the 250 and think that they're actually getting that money right then and there. But usually those terms and agreements either have certain interest rates that apply with them. You have to have a minimum like deposit in order to get that banking account at that particular moment. So you have to make sure that you're understanding what they're actually saying. When a bank is offering you like a free account, is 9 times out of 10 they just want to get your business in order so they can upsell you into an actual product that they will again make money off of you from. That is the name of the game. And the game is not wrong if you know how to utilize it. Okay. And so we've talked about checking account. Any questions on checking account? Good, moving on. Savings account. So savings account are the oldest type of bank account. The bank wants you to save your money in a savings account so that way they can loan it to other people and pay you interest on your savings. So savings accounts are meant for like medium to long-term savings, and this is because banks need a stable deposit in order to issue loans that they cannot loan out money if everyone tries to take out their money out of the savings account every single month. So to encourage a long-term savings and basically say that more money is available for them to lend out, banks usually offer a higher interest rate if you keep more cash sitting in your account for longer periods of time. That is essentially what a savings account is comprised of. Now, some people like to put in their savings account like, I say a good rule of thumb to having your savings account is like your emergency fund or any expenses, like 3 to 6 months worth of expenses of your household needs. You don't want to have too much, like I said, you want to have a medium to long term. You don't want to have basically all of your money in a typical just traditional savings account. We'll talk about the different accounts that'll actually earn interest, but for these purposes, a traditional savings account, you want to ideally think emergency fund, 3 to 6 months of expenses, right? So the balance required, if you have zero money in your savings account, this is a typical like traditional savings account. If you have zero money in there, you will earn 5%, or not 5%, 0.5% interest rate. That's not that much. It's literally, let's say, 5 cents on the dollar. Okay. If you have a balance of 10,000 in your savings account, then you'll earn about 25% or 0.25%. So that's about like a quarter of a dollar. Hold on, 0. Yes, that's about a quarter of a dollar. There we go. I had a little brain fart. All right, and if you have about $25,000, that'll get you 0.75% interest on that money that you build up. So the more that you keep in their deposit, the more that you actually earn. And even when the highest amount is still not that much in interest that you're actually earning. So when you think about investing, your savings account is the most basic option. You don't really yield that much reward from it. It's, like I said, for medium to long-term investments, like if you're building up for something long-term, that's probably a good place to keep it up until you're able to move it into another account that has a higher interest rate for you to be able to actually yield some type of return off of that money. So now we're going to talk about a risk versus a reward. So the key aspect in investing is risk versus reward. If you have less than $250,000 in your savings account, it has a protection from the FDIC, which is a federal agency set up to ensure that your bank accounts at no cost to savers. So this means that you're putting your money into a savings account and it has almost absolutely no risk, but the interest rate is super low, and it's also very little reward. So basically saying that, hey, you can hold your money here. We're not going to take it from you. And if we happen to take it from you, it's going to be insured and we'll give you, you're guaranteed to get that money back. You can earn a little bit on it, but there's really no incentive to give you any type of reward because it's less than $250,000. So the FDIC protection only applies to deposits made at an approved financial institution like a bank, a credit union, a savings, and a loan institution. It's very important that you know that mobile pay accounts, unless offered by a bank, and cryptocurrency wallets do not offer this type of protection. So putting your deposits are at a risk. And that is the little toggle that you hit when they say terms and conditions. Mobile payment options, mobile payment accounts are subjected to, say, if they take your money, they are not liable to give you that back because it is not FDIC insured. That's what that means. So when they say, hey, is this FDIC, like if this is this FDIC insured, that means basically, am I covered if y'all decide to take my money or something happens to my money? Am I covered to receive like that return back? Am I covered to receive my money back, to get my money back? And unfortunately, a lot of people are not privy to the fact that if you are not depositing money through a banking institution, um, or it is FDIC insured, you want to make sure that is plausible, that there is not a guarantee that if they just happen to take your money or a glitch happen and your money just evaporates into thin air, that you'll get it back. And you agree to that when you sign on to those terms and conditions. So just be mindful of that. You are putting your deposits at risk when something is not FDIC insured and you basically are just exchanging money over the internet or exchanging money over different mobile accounts that are not FDIC insured. So if somebody takes your money, you are not guaranteed to get that money back. And that is what you agree to when you sign up for that and put those terms and agreements in there. So now we're going to talk about liquidity. Or do we have any questions about that? Okay. Now we're going to talk about liquidity. So there is this concept of liquidity when it comes to checking and savings accounts means that basically how fast can you convert your investment into cash, and if you need to spend it, how are you able to make sure that it is in cash in order to be accessible to you? So the more liquid that the asset is, the lower reward that you can expect. If you want to earn more interest in your savings account, you need to basically lock up more cash than you can't that you cannot withdraw or spend. So a checking account pays you very little to no interest, but you can spend it on whatever you want. And for all other investment types, keeping this balance in mind, less liquid and more risk usually has a bigger reward versus more liquid and less risk usually has a lower reward. So again, liquidity is basically just saying how fast can your investment turn into cash? Does anyone have any questions over that? Perfect. Moving on. So now we're going to get into certificates of deposit, which are commonly known or seen as CDs. And with a CD, you actually agree to deposit a specific amount of money for a fixed period of time. And this is called maturity when you keep it in for a fixed period of time. And in return, your financial institution agrees to pay you an interest usually higher than a regular savings account over this period. However, if you have limited opportunities to limited opportunities to actually access these funds, and you only want to use CDs for cash that you don't anticipate on needing until your CD actually matures. So you want to keep it in there for whatever the term rate is, and you don't want to have to need this money like soon, because you want to wait until it has that maturity level with that interest rate because it'll grow. So your bank will offer you many different types of maturities or different terms for your CDs, which is vary from 3 months to a year, 2 years, 5 years, the terms vary. And so generally, you'll find that the longer the term of the CD, the greater that the interest rate that you'll actually earn. And there is a catch, and I want to make sure that you know this. If you lock your money at today's CD low rates, then the rates go up. Like, so say you happen to lock it in today at like 3%, but the rates end up going up to like 12%, you've missed out on that higher rate. And because it's locked in, you cannot change that. You have to allow it to go through the longevity of the maturity at that 3% rate. And you can't just be like, hey, the interest rates went up, so let me go ahead and take it out and put it in at 12%. No, you're locked in at that 3%. So that's kind of like the only catch. You have to be able to know when to um, actually put in your CD. So when you buy a CD, you're locked into that interest rate for the life of the CD, whether that be the 3 months, the 1 year, 2 years, 5 years, whatever the amount of the longevity of that CD is. So if you take out your money before the full term or before the maturity, the bank will actually charge you a penalty to make sure. So you want to make sure that you understand the term and the penalties involved if you suddenly need the cash or if you want to like basically bust your CD. And when it comes to CDs, you want to make sure that typically you're not going to need this money within 3 months all the way up to like 3 years. That's like a good safe spot to where you can be able to have a good interest rate, see the maturity of it, and be able to withdraw it and get it back. So, yeah. Any questions? You also want to consider which direction that you think the interest rates are actually heading in. So, if the interest rates are very low, you don't want to lock in a low rate for 5 years because you're not really going to see that maturity grow and you're not going to see your money really work for you. So, you can't just um, you can't just bust your CD and then buy a new one with a higher interest rate if the current CD hasn't actually matured yet. On the flip side, you're practically guaranteed of getting a fixed rate of interest on your money to complete the term of that CD. So if the rates are really high, then you might you might want to lock in a higher rate for a longer term. So say the rate is at like 11%, you want to lock that in and maybe say over the tenure of 5 years. Again, you want to make sure that you're not needing this money or having any access to this money before the maturity of the CD is actually up because you will be charged a penalty. So basically, that's like taking money away from yourself. You're just giving away money at that point. Um, the last time that we that there were really high interest rates in the US was actually in 1980s and the rates of the CDs were 18%. Now the interest rates for CDs are very low at around 2% for a year and around 3% for 5 years. So it's not really that much. It's kind of like around the rates of a high yield savings account, but we'll get into that a little bit later. A keynote that I want you guys to be aware of when it comes to CDs. So you want to watch out for rollover clauses with your CD. So basically, after your CD matures, say you put money in and you've had it and you wanted to mature it for about 3 years. So you have it in, it matures to 3 years. Some banks only give you 7 days, which is a week, in order to withdraw your cash before it automatically rolls over into a new CD with the same exact original rate. So, say for instance, you put let's say $10,000 for 3 years into this CD at 3%. If you don't withdraw out that, which I think what 10,000 at 3%, $300. So I think it would be like $10,300 at the end of 3 years. Say you don't withdraw that money after the CD matures within that 7 day period, they'll automatically keep your money and basically put you in for another cycle of 3 years at 3%. And if the interest rate went up to 10%, well, you've just tripled your investment. However, because you did not get it out in that window time, you did not actually allow yourself to see the maturity of that 10% and you're still stuck at that 3%. Does that make sense? I hope that made sense. I hope I didn't confuse you. Next Finance Friday, we are using the whiteboard, but I have stuff written on my whiteboard. People on YouTube can see it, but yeah, we're going to be using the whiteboard. Okay, so we talked about CDs. Now we're going to talk about money marketing accounts. But before we talk about money marketing accounts, are there any questions? Alrighty. So, money marketing accounts, or commonly known as MMAs if you see it, these accounts are designed to be a combination of the features of a classic savings account and a CD, but some typical features include a higher interest rate than a traditional savings account. There's no maturity date like there is with a CD, so basically there's no end date. And then a minimum balance that must be maintained, so maybe around like $2,500, and then limited withdrawals each month. So that's typically about 6 transactions a month that you like after 6 you're cut off. You can't withdraw anymore. Like you're done. And I don't want you to confuse the money market accounts that are offered by the bank with the similarly named account offered by investment firms. They're named the same, but they are two different things. And you have to know which institution you're actually pulling from in order to know which account you're actually working with, because they are very, very different. Bank MMAs are another form of a savings account that can carry the federal insurance, currently up to $250,000 per depositor, which all other deposit accounts, they typically love seeing that. And then the similarly named product offered by investment houses is typically a short-term investment in one or more of the mutual funds that may or may not generate positive earnings. So there's also no federal insurance protecting your principal investment. And I'll use the word principal in replace of investment because they are interchangeable. So basically, a bank MMA, you are guaranteed to see the return and interest of that. With an investment MMA, you are not. It could go up, it could go down, and that is where the risk versus reward comes into play at. So when you have one of these savings accounts, you are really loaning your money to the financial institution. Any questions? All right. So the bank or the credit union pays you interest for making these types of loans. And unlike most loans, you are usually guaranteed a repayment, even if your institution fails. And in the case of a bank's failure, the free federal insurance you receive actually covers that loss. So you want to make sure that you are paying attention if the MMA is through a bank institution or an investment institution. Okay. A rule of thumb, if you're sitting on some cash and you have a substantial payment like your children's tuition, or you're planning on buying a new car at year end, a common, or something that's coming due in a few months, go ahead to your bank and see if you have any choices that are available to you. Even if it's just 1%, an extra return on $10,000 over 6 months, that's about $50. And so just think of it as spending 5 minutes at the bank and then you get a free dinner in 6 months. Like, essentially, if that's how you want to look at it. All righty. Do we have any questions? Do we have any questions? All right, so that's it for this week's Finance Friday. I hope that was a plethora of information that you guys were able to receive this week's notes. We're really on the banking and understanding the different types of accounts that you'll have. And next week, we're actually going to get into stocks. like how to understand them, what they are, and getting really more so into the investment world. It's very important to understand what type of accounts that you do have, because you then understand what type of interest rates and what types of terms and agreements that you're actually working with in order to utilize money as the tool. Because $10,000 in a checking account is not the same as $10,000 in a savings account, which is also not the same as $10,000 in like a CD or a money market account. And you want to know the difference between those two, because there's about 0 to about, let's say, up to 18% difference in between those two. And you can really change the trajectory of how you use money. And instead of it being something that is depreciating, you want to make sure that you're transitioning it into something that is appreciating. Depreciating meaning that it is losing value over time, and appreciating, which means that it is gaining value over time. So hopefully today's concepts helped. If not, please reach out to me, comment below or anything, and I'll be more than happy to answer your questions. Again, I am not a financial advisor. However, this is something that I'm very passionate about learning and studying and just diving deep into. And as somebody who has had a background in accounting, as well as understanding how money works, essentially, I think that this is very important information to have accessible. And sometimes people just don't know where to look or where to start. And that was my core reason for even starting this channel. So I hope that the information that you find here is helpful and useful, and you're able to utilize it to the best of your ability. So without further ado, I'm going to go ahead and end this, but thank you guys for coming. Please like, comment, share, and I will see you guys next Financial Friday.